It's me. It's Bruce Whitey. Honestly, that's all I'm going to goof off. This is a serious show today. No goofing off, okay? Hey, welcome to Straight Talk Wealth Radio, podcast, video, TV, whatever you want to call it. I have a really important show for you today. These are shows or are they classes? I don't know what they are, man, because it's like we do so much education on this. I have a really, really important topic I want to talk to you about today. Today's episode is called Why You Can't Decide. Why you can't make up your mind. Because you know what? There are a lot of cross signals going on right now. And I'm talking about a dilemma that is an affliction for so many people I see coming into the office. And that is, I could go this way, but I could go that way. And some of them, it's been going on for years. I think this would be better. I think that would be better. And they're totally frozen about making a decision because they don't know what's best. So one thing I want to look at today is I want to look at left or right, up or down, conservative, aggressive. How do you decide what's best? Because at the end of the day, you can't. You can't know what's best. So that decision is a wrong approach. There's got to be a way to cope with the fact that you don't know. And how do you deal with what you don't know? So obviously, the answer is going to be asset allocation. It's going to be that you spread the chips. You don't know what number the roulette wheel is going to fall on. And you would be a fool to bet all your chips on any one number. That would be ludicrous. Well, the same thing occurs, but we can add much more science. It's not just the roulette wheel, although there is that part of it. But we can apply much more science to making that decision of allocation and probability in the financial world. We can apply a lot of science to it. So what I want to look at today is I want to look at the differing points of view of what might happen, the differing approaches to how one might try to choices that one might make. You know, if you think it's going to blow up, if you think it's going to go big. And then I want to get down to that, what it takes to crowbar someone out of that frozen look of the deer in the headlights. I don't know what I want to do. I can't make up my mind. Do I bet this way or bet that? There is a very easy, logical approach to it. We do this in our office all the time. And there's a couple things I want to say about this. To do that, I'm going to tell you right now what the answer is. And I have some really good things I want to give away at the end, like some reports that we can do for free for you that will help you unfreeze your ability to decide what the future might look like, but what you can be doing about it and how to allocate chips that works for you. So we have some really good tools that we're going to do for free and give away to people that respond. And again, we have had Straight Talk Wealth Radio, by the way, goes back to 2007. I was on the air in Los Angeles and Southern California starting then. I sat in Dennis Prager's chair at KRLA Studios in Glendale. Dennis worked it during the week, and I would come in on Sundays and do my show. And we developed quite a following from that. I got very, very busy in my office with client work and kind of pulled away from doing shows and all of that just because I was working one-on-one with clients. But here's the most important reason why we're on back doing the podcast again. Because, I'm counting how many words. Because things are going to change. 6 words. 6 words you need to always keep in mind. Why we do Straight Talk Wealth. Because things are going to change. One, they're going to change in the economic world. They're going to change in terms of where we're going and what the markets look like and what growth looks like. But they're also changing because most of our audience are at a change of life in terms of who they are as investors and savers. They're leaving the accumulation phase. They've accumulated over the years. How do you accumulate? You get an income source and you put money away and you just put money away and you try to build it up. And you have very simple math. You try to make good choices about what to grow your money most aggressively as you can. And you made 7% one year, and then you put some more away, and you put 100,000 away, and then you made 10% on that, and then you put 50,000 away, and then you lost 8% on that. It's just what you put away and the ups and downs. But what's going to change when you retire is your job has logarithmic algebra involved, calculus, moving pieces, such as how do you spend your money? Because your job in retirement is to spend it. That math totally is a different math. How long are you going to live? I don't know how long I'm going to live. Well, you better figure out something. You need to know how much you can spend. What about inflation? I don't know what inflation is going to be. You better prepare for it. What's your portfolio going to grow during that time? I don't have a clue what it's going to grow. How do you stop making money? I mean, I don't know about you, but most people I know worked their butt off for 30 years to pay the bills, let alone accumulate a nest egg that now for 30 years, they're not going to work, but they still got to pay the bills. And you better know on day one of where you start, where you're trying to land. So it's a much more complicated process. So it goes back to, because things are going to change, we're on the air talking about it. Things are also going to change because yes, you've got Medicare, you've got other things that come in, you got your Social Security as an income source, but we haven't even touched the issue of long-term care. At some point here in a future episode, I think I'm just going to dedicate a whole episode to talking about my mom. My mom, quick story on this. It's a long-term care story, but we'll talk about another issue, another episode. I'm not going to talk about it here, but I do want to just mention my mom, and I'll tell you the whole story, but my mom needed to be cared for 14 years. The year that she went down and couldn't care for herself, my dad said, if anything happens to your mother, I'll take care of her. Well, by the end of that year, 2002, my dad had passed away. My mom needed 14 years of long-term care assistance. It cost my dad's estate $1.5 million because no provisions had been made for it. And I know from the inside about that story. I also we can talk at future dates about my own family. My son was born at 1.5 pounds 38 years ago. He shouldn't have survived statistically, but he did. Lovely kid, wonderful kid who's a 38-year-old, 3-year-old that watches Barney and Sesame Street. And we're having to deal with, my wife and I are having to deal with estate planning, special needs planning, all of that. We will have shows on. We'll have attorneys that specialize on that as guests. We're going to have a lot more guests in 2024. So watch out for that. I'm going to bring in some great people. But again, what I want to go back to today, and I've got a little hot list here of some videos and some articles I want to cover. But the first thing I want to cover is end of 23 seeing a pretty nice rise in the markets. And you may be seeing this a little bit after all of that. You may be seeing this into 24. But end of 23 had a great run. Investors are getting complacent. They think that we're through this. They think, I guess, all the COVID stuff, all the inflation fighting, Feds raising interest rates. I think it's just going to be as it is. And it's growing. And they're complacent about risk. Well, maybe for good reason. Or maybe for not. So let's look at that first of all. Let's just see, is the economy going to change? Are the markets going to change? Is investing trends, are they going to change? And then I want to go back to, again, the theme of today's show, which is why you can't decide, why you can't make a decision, and how do you get yourself out of that trap and that quicksand. So let me look real quick at the list of videos here I wanted to cover today with you. Okay, let's start with this article here from Yahoo Finance. A severe recession may be coming in 2024 as the stock market, job market flash warning sign, strategist says. And these videos are supernumerary at this point. We'll just go for the article. The U.S. could be in for a severe recession in 2024, Briley Wealth's Paul Dietrich warned. That's due to an array of recessionary signals that are flashing in the economy. Now, mind you that the background on this is we're doing pretty good. The market's doing pretty well at the end of 23. It looks like the smoke is cleared and everything's fine. So are things going to change? All right, goes on. The stock market's explosive rally, which we just experienced, is one such sign the economy could soon contract. The U.S. could fall into a severe downturn in early 24 as a handful of recession signals flash throughout the economy, according to Briley Wealth's chief investment strategist, Paul Dietrich. In a note Friday, Dietrich pointed to a monster gains investors have seen in the S&P 500 this year, with the benchmark index notching its best month of the year in November. It was incredible. That rally has largely been fueled by expectations the Federal Reserve will cut interest rates early next year, but rate cuts likely aren't coming until the economy tips into a downturn, Dietrich warned. Investors shouldn't count on the central bank lowering borrowing costs unless the U.S. economy falls into a severe recession, which may happen early next year, Dietrich said. The Fed typically starts cutting rates when there is a sharply slowing economy and rising unemployment, meaning a recession. Signs of recession are starting to build, Dietrich notes. The stock market's 20% rally this year is one such warning, he says, as the S&P 500 has typically posted outsized gains in the months before leading up to a downturn. So here's the first indicator. S&P posts outsized gains in the months leading up to a downturn. That was the case prior to 2001, 2008, and 2020 recessions when stocks rallied sharply before the economy began contracting. There are other stock market disconnects that are making the case the economy will soon roll over into a downturn. Though the S&P 500 is up overall for the year, the S&P 500 equal weight index, which is a more representative of the average stock, has fallen into correction territory. Okay, we got one S&P raging and one that's correcting. The labor market is also starting to weaken. Although the overall unemployment rate ticked lower in November, continuing unemployment claims briefly rose to 1.93 million last year. That's the highest continuing claims and have been since late 2021 and are at what Dietrich describes as recessionary levels. To think that a 13-year bull market we will not see a normal cyclical bear market is to believe that the business cycle has miraculously been repealed after 400 years of stock market cyclical data. The belief this time will be different. The never is, he said, of investors' recession outlooks. All right, so he goes on a little bit more. There's another article I found. By the way, I want to share this with you. If you haven't seen our website or Facebook site for Straight Talk Wealth Radio, it's modeled by a very handsome young man. And we keep up to date on this. This is a good one. Go visit us. We're up here, facebook.com/Straight Talk Wealth. That's how you get to our Facebook fan page. Follow the articles, because I try to, one of the shows are posted here. This is last week's show over here. And this is an article I posted about David Walker. Now, there was another article. Oh, it's in there. Good. All right. David M. Walker, another interesting guy. We're going to have him as a guest on our show. He is the former Comptroller USA. He talks about fiscal responsibility and is there a price to pay the fact that the government is always in deficit and debt. Outspoken guy. This is the guy. David M. Walker ran Social Security and Medicare. He was the custodian of Social Security and Medicare for 5 years. If you ever wanted to know, is Social Security going to last? Is Medicare going to be there? I'd want to ask a guy who ran it for 5 years. We will have a new interview with him. I previously interviewed him, and I will tell you, basically his words were, Bruce, they call them trust funds, but you can't trust them, and they're not funded. So anyway, this is a great little talk he gave recently at some audience that he did. This is the last week's show. This is what I want to talk about right now. Let's see if I can blow this up a little bit on my screen. Here we go. That sinking feeling, punch bowl leaving soon, I'd always hedge my bets. Warren Buffett is selling $28.7 billion in stocks, and it's ringing an alarm over the economy. In a move that suggests the U.S. economy isn't out of the doldrums yet, despite consistently According to Berkshire Hathaway's second quarter earnings released earlier this month, The company sold close to $13 billion worth of shares. It's a lot of cash. Economy's running on fumes. All right, let's read the article. Warren Buffett's firm, Berkshire Hathaway, sold $28.7 billion of stock in the first 3 quarters of 2023, in a move that some enthusiastic economists have interpreted as ringing alarm bells for the American economy. According to the company's earnings, Nebraska-based firm of the legendary investor and billionaire known as the Oracle of Omaha sold a net $10.4 billion of stock. All right. Kind of saw it really in the video here. I don't want to have to repeat myself on all of this. It's just another indicator, okay? So now, the thing is, what have we got here? We're talking about, let's go back to here. So here's what we're talking about. This is why I'm bringing this all up. We've had a really good run up at the end of 2023. So maybe we're not going to have a recession. I think the best thing to do is just stay in the stock market. It's roaring, right? No, there's signs that it might fall. It might fall? Well, then I should get out. No, you should stay in. It might be good. Bonds. Bonds had really high interest rates. You get a lot. I know, now everybody flocked to bonds and the interest rates are falling. Where do you go? How do you make up your mind? I got to know what's best. No, you don't need to know what's best. So I'm going to do one more video here about the economy, and then I'm going to go over some slides from my personal library to help kind of cover how to get through this. Okay, this was let's see where that gentleman landed here. Yep, here we go. Just a different look. This is a guy, I don't know a lot about him, the Liberty Daily. He's on Rumble, but I liked his analysis. I heard it the other day. I just thought it had some insight in it.
Recession is coming and government numbers are hiding it. A few days ago, the Wall Street Journal published an article worrying that the job market is failing on all fronts. This matters because jobs were the last man standing in this very non-recession of ours, and they are now giving up the ghost. Zero Hedge was more direct, saying the job market is, quote, imploding. What knocked the Journal off their everything is fine script was a drumbeat of new numbers showing unemployment is rising, wages are falling, Americans are taking longer to find a new job, and they are holding on to bad jobs. But what really sealed the deal was a huge number that came out just after the Journal hit publish: job openings. Those were down 800,000 on the month and missed expectations by over 500,000. Now you might wonder why Wall Street pays analysts who miss by 500,000 jobs, but to be fair, they are working with government numbers here. I've mentioned in recent videos how jobs are the only thing saving this economy. Almost every other number is either recession level or is dragged out of the recession gutter by those jobs numbers. Of course, a lot of that is smoke and mirrors, given that roughly 5 million Americans dropped out of the workforce during COVID, either retiring early or bribed onto the couch by government benefits. Without that, unemployment would be about 6.5% to 7% right now, which is almost exactly where it was at the beginning of the 2008 crisis. Still, even that free lunch is running out. Along with the 800,000 missed openings, the BLS also revised 848,000 other jobs into oblivion, which is really fun since media reports the good news immediately. That all gets a lot of press, and then nobody notices the revisions. Now, for those following along at home, that means we've lost almost 3.5 million job openings since the Fed started hiking. So that's about 30% of all job openings in the economy. Meanwhile, other real-world indicators of the job market are also fading along with it. So workers have stopped quitting jobs, meaning they're afraid of finding another one. Holiday hiring is anemic. Normally you get a lot of temp workers. Raises are getting smaller, which is pulling out the last thing that was keeping wages at least close to keeping up with inflation. Finally, continuing unemployment claims, that means people who can't find jobs for longer and longer periods, has been on a relentless climb since September. So what's next? Brought to you by Unchained. Beyond the ugly spectacle of governments lying about numbers, the risk is that the Fed could be raising rates into a much weaker economy than they think. This could lead to the mother of what economists call policy errors, meaning the Fed goes way too far and then it has to whiplash back. To be fair, the Fed has done that in almost every recession because it's incompetent, so it should not be a surprise. But given the magnitude of this one, it could get very ugly. Okay, we'll be watching. See you next time.
All right, nice analysis and nice look behind the scenes at what might actually be taking place. Last week, you heard other people say that the Fed usually doesn't quite get it right. And so last week, we kind of talked about how we look. First of all, I just want to set the scene that we manage risk differently than the old paradigm. So a little animation here. We feel very strongly that it's time to change how you think about risk. So, and of course, if you don't change your thinking, you wind up with the same problems you always had. That's a quote from Albert Einstein: "We cannot solve our problems with the same thinking we used when we created them." So what I want to say about risk is this. This is the old paradigm. This is traditional risk paradigm. And in these times, this is why you're so locked up in your thinking about having to know what's best. Because your risk is, as it's traditionally been, which is, I might lose my money. Now, we know you can't make money if you're not willing to lose money. So if I want to be able that I could make some money, I have to be able to lose. And so you're constantly between make money, lose money, make money, lose money, and that locks up your thinking. Okay? We have a different approach, first of all. And not that there's no decisions to be made. There's definitely decisions to be made. But the consequence of these can lighten up a bit. So first of all, we look at three major categories. One is we eliminate any losses. We will not suffer a loss in any portfolio. So we take that out of the picture. If the markets are falling, if we have a recession, we're not worried because we're going to stay in the preservation mode, which means I might make nothing. It's possible I could come in with a zero if the markets are downturning, but it won't be a negative number. So you're going to preserve what you make in all cases. Now, we can go to fully guaranteed gains, which are higher than these because of high interest rates now. I should have corrected the slide. They're substantially higher. We're looking at up to 8% guaranteed gains if you just want a guarantee. So in some of our accounts, I'm going to say we're between 5.5% and 8% on the certainty level, which is I will make something. Guaranteed interest, even if slightly less than inflation, although since inflation's cooling and we're still enjoying the higher interest rates, we have an inversion going now where we can actually guarantee rates that are higher than inflation, up to 8% right now. And then we could do even better. Again, I would say this number is now maybe 8 to 17 or so. If there's growth in the markets and we want to link to the growth, now the hardest part about this is you do have to allocate amongst these three options. You do have to create that allocation. If the markets are going to grow substantially, I want to be all in on this, but I don't know. So if I'm a little bit in on this, and if my market, these two are actually, the top and the bottom are one and the same, meaning that when you allocate to growth in the market, if it goes backwards and the market goes down, you're not actually in it. So the worst you can do is make zero in a down market, but you can make double digits in good markets. And if you don't want to do the 1 and 3 combination, then you just go to the middle one and you say, you know what, this year I think the market's going to be down anyway. So rather than giving me a 0 in a down market, just give me like a 5 to 8% guarantee and we can do that. So that's our paradigm, first of all. That's important. If I'm going to talk about how to make decisions. So there's a process in terms of how do you know. Now, first of all, let's be clear about this. In the realm of preservation accounts, preservation strategies, getting growth when growth is available, but preserving from downside, I've given you 3 options. Here we go. 3. Okay? Which is markets go down, you won't lose anything. If the market says, I don't know, I just want something for sure. If you want something for sure, we can go up to 8%. And if you want to ride with the market, we can get you double digits if the markets go up. But if they go down, you won't lose anything. Those are 3 options. There is a world of other options. A world of them. Okay? You might want to leave some in the market. Maybe you know what best companies, best funds. That's an option. You might want to be in real estate. You might want to be in precious metals. There's a million things you can invest in. So if you're sitting there with all of these trying to figure out what's the best one, you will go crazy. You will freeze up and you will not decide at all what you're going to do. So what you have to do is here's the process. Now, in this case, I'm only talking about what you're leaving in the market versus what you're taking out. Let's just say that my 3 options I'm giving you here are one set. The other set is everything else that might be in the market. I'm only going to deal with that right now. I'm going to show you some diagrams of much more complicated portfolios. But right now, let's just talk about in the market or out of the market. The process is 1, given the potential for even greater market losses, just ask yourself this question. What percentage of your investment and savings portfolio do you want to leave at risk versus safe over the next few years? So it's not a matter of should I be in risk or should I not? Because ours have no risk of loss. Might not be the only game you want to play. But the first question is, how much do you want to leave at risk? Another way to answer this question is, how much of your portfolio are you comfortable losing before the economy and markets come back? So what losses, if you can't confront this question, if you can't come up with an answer to this question, you have no business being at risk with your money. But if you're going to be at risk, then qualify it a little bit and say, how much am I willing to lose before I couldn't tolerate it? Okay? And that will help you sort of decide how much of your money has got to be safe versus how much can be at risk. So let's say that it's real to you that in a bad market, you could lose 50% of your money. So in that case, that's possible. The market could lose 50%. And so if you feel like you would be willing to lose 25% of your portfolio before you see the markets and the economy come back, you'd be willing to take a 25% loss in the portfolio, and you believe maximum risk loss is 50%. That means 50% of your portfolio's gonna be at risk in the market and 50% isn't. Think it through a little bit. I think the markets could lose, and again, the math, we could do a calculator and all the math, but I'm keeping it simple. If I think the markets could lose 50%, that's a lot, but you could make it 30%, 20%, whatever you think the market could lose. So let's say I think the markets could lose 50%, and I'm only willing to lose 10% of my portfolio. That tells you, informs you, that you could leave 20% in the market and 80% out. Because if the market loses 50%, now that gives you 20% you can keep in the race, but it gives you a tolerable way to measure the risk. Now, out of risk doesn't mean not making money. It just means changing the paradigm. They're not like, you have plenty of potential to win in a non-risk environment, but let's be honest, it's hard to get a gambler away from the table. So we have to give them a process to grant them that. So suggested allocations. ask yourself, now, once you go into the non-risk area where we work, there are a couple ways to allocate that. Sometimes you can create an income-driven portfolio. Sometimes you can create just a capital growth portfolio. So if you want to be in the just guaranteed interest, then ask yourself, do I believe that the S&P 500 will be positive a year from now? If you don't think it'll be positive, then just allocate either to what's called a trigger method. We covered that in other shows, or just go get the 8% guarantee. That's the next level of sort of figuring out. Because once you go to what I'm doing, you still have an allocation between those three things. So that's simple. The process is, do I think the market will be up next year? I think there's a good chance it'll be up. I got to have safe money on the side. I don't want to lose it. I realize I could put it toward the growth of the market, but it won't lose anything. Or I could put it towards that 8% guarantee. So what you're going to ask is, do I believe the market will be up? And that helps you further out the allocation. If you think it's not going to be up, then just elect for the guaranteed annual interest and revisit the question a year from now. This is all in the no risk environment, which is just, how much can you lose from your portfolio? Good. Now you have the no risk environment. Within the no risk environment, ask yourself, how much do I believe the S&P will be up? And go with the ones that carry with the index. How much do I believe that it won't be up? And just get the guaranteed growth. And we get people through this all the time. If this sounds complex, you really do need some help. It's not that complex. All right, a couple other things I wanted to say about this real quick. Then I'm going to show you some other types of analyses we can do, and then I'm going to wrap it up. These are some notes I made about the stagflationary environment that we are in today. Some general rules that I think are important to follow. Today in this environment, don't lose money to shifts in down markets when the recession comes. Don't try to guess the turnaround. Because if you think, it's down now and I'm now going to throw all my money in the market, and I'll grant you that to a degree. But the earlier formula of how much you're willing to use would still apply, because there could well be a third leg down. You don't really know where the bottom is. And if you knew where the bottom was and you know where the top is, you're ahead of 90% of investors. So good luck to you. And God bless you. I should have you on the show if you catch all those. Don't lose money to inflation by sitting on the sidelines. So you do have to be invested. You do have to have your money growing. But don't lose it to shifts when the market hits recession. Stay flexible. Be able to shift and strategize year by year. So all of these decisions and these allocations need to be sort of reworked each year. And this is another thing that we do in our office with all of our clients, is when they get their annual statements, they call me and we do a whole fresh look at the allocations and whether we feel for the next year ahead, are they right? Do they need to be tweaked? So this is the trick to actually winning with what we're doing. There's a couple of things I want to say about that, but I want to show you two other forms of analyses that can also be employed. This is a retirement roadmap, believe it or not. Can you tell? It's Mrs. Susie Sample, or Deborah Demo. And this is an actual client I want to show you. This is another factor in how you decide risk tolerance. First of all, a portfolio has a purpose. It's to give you a lifetime of income in retirement. A portfolio is there to free you financially from the burden of having to go work every day to make the mortgage, the rent, the food, the trips, the vacation, the car payments, and all of that. You want to be independent of working to be able to meet those needs. Now, this is a very modest person in a modest portfolio. We've done these. This person, we have their stated income goal is $35,000 a year. Okay, that's how much they need, and you'll see that in this little blue line. That's how much money they need each year to live. The reason it's going up is we have embedded a 3% inflation rate into it. So right here, first year they need $35,000. This person is 67 years old. They need $35,000 to live on. But if you carry it forward to the year 2028, they're going to need $40,575 in order to sustain that lifestyle. Okay? Now, I'm going to see if I've got some notes here on their overall assets. I don't want to get into the whole portfolio. This person has $357,000 in taxable investments. We are running that at, we actually embedded that at roughly 5%. There was some cash in there, so it averaged out to 3.9. But we were figuring as a model that the portfolio would grow 5% a year every year without any skips. So we're incorporating maybe some down years. We're averaging it all up to 5% a year. They're getting a $21,000 Social Security benefit, which we have inflated. Qualified taxable is $357,000. Qualified accounts, that's 401ks, IRAs, is $366,000. And non-qualified, they have $30,000. I think that was just in a tax-deferred annuity that was non-qualified, was not an IRA. So there's their resources. Oh, they have $7,300 here in a Roth IRA. That's the resources. They have no pension. They're getting their Social Security, and they got to make this last. Fortunately, this client has a very low standard of living. And what you see is this. As you move forward, let's take this year, 2025. Client 69 years old. They need $37,132 after taxes. We have dialed tax rate into this. Okay, now where I'm going on this, just so this isn't just a mundane exercise, I'm trying to figure out if changes are needed in their stance or whether they're fine. And if changes are needed, that adds a perspective into why you can't decide. Because if you haven't done this, now you don't even know what the portfolio's trying to do. You don't even know where the portfolio's trying to get you. You're just moving numbers around. People come in my office and they're like, Bruce, what's good right now? What's good to invest in? Like, I don't know you. Who are you? Where are you in your road toward retirement? Already retired? Approaching? 20 years from now? 5 years from now? What's your portfolio look like? You can't go find the hot thing and put it in perspective and advise people. You would be criminally remiss if you didn't do some kind of analysis first to say, who is this person and what are you trying to get the portfolio to achieve? In this case, I'm going to define that I'm trying to get the portfolio to achieve a lifetime income of $35,000 a year. That's all this person wants to live on. And have it last forever at a 3% inflation rate. But I'm going to show you a trick in a minute, because I will always stress test a portfolio beyond what I'm asked to do. I want to know where the limits of it are. So, for example, in this case, again, $35,000 income at 3%. What you see, the blue line is the Social Security coming in. We run Social Security a little less than inflation. I think I have Social Security inflating at about 2.2% if real price inflation is 3%, because I always figure the government's going to hedge on you a little bit. All right, now, this is the retirement income graph. You also have a savings graph. All of this is called a retirement roadmap. This is what we do on a retirement roadmap. I wouldn't dare suggest to a client if I hadn't done one, because I don't know what to suggest. So this is why we do this for free. Anybody who's interested in having us do this, we can put together in detail. There's no charge and no obligation, because I don't know what the stink I'm going to say to you that you need to do if I haven't done this. So, but the revelation of this for most people is great just of its own. We always do it for free. You can find that on our website, straighttalkwealth.com. All right, so if you go to our website, straighttalkwealth.com, that's straighttalkwealth.com, click on the retirement roadmap, and you will come to a page that describes this analysis I'm showing you right now. The video is a little bit dated, but it does go over how we produce a retirement roadmap. It's just a great video. I did it 10 plus years ago, and it's still very relevant. And then you can request one right here on the forum. And we will call you back and ask 6 basic questions, get a snapshot of your situation, and we will do a full retirement roadmap. So I just want to indicate to you that what I'm showing you is a free service that we do, and all you need to do is go to straighttalkwealth.com, click on the link for retirement roadmap, and request one. We'll be happy to follow up with that. All right, let's go back to the result. So if this graph is a picture of where the income is going to come from to satisfy our clients' needs, This is a picture of what the portfolio looks like. And under these circumstances of 3% inflation, a modest income, and a portfolio that's growing at 5% a year every single year without skipping a beat, you got good growth all through retirement. It actually shows that the portfolio right now is a total value of $761,000. And gosh, by the time they're 89, it's going to be up $2 million. Perfect. No problem. Go home. You don't need me. Get out of here. But let's stress test this a little bit. How does it look? This is the time value of money. What happens at 4% inflation? All right, so the portfolio peaks out somewhere around age 82, and then it does start to drift downward. So this is a tricky thing. This is a thing we call principal spend down, a slippery slope. It is when you are starting to eat up your principal in retirement, and then you can't get the interest out of it because you spent more principal, so you get less interest the next year, which means you got to spend more principal, and the rate of that starts to spiral. So it's a tricky area. But, look, my graph says when you're 98 years old, you're still going to have $500,000 left. What do you got to worry about? You're going to be 97, you're going to be worried about your money, and you're going to remember that Bruce Whitey told you, he told me I was going to have $500,000 when I'm 98. I don't think I'm going to live more than another year, so I'm going to go party. Still a slippery slope. Still not a good direction to be in. If we happen to get to 5% inflation, something important happens. Now we are in a broken portfolio. This is what I mean by stress testing. So now we actually have shortfalls coming up. When you're granted 96, but you will be short over here $63,000 that year of unmet expenses. And don't forget, this is someone who's living at a level of $35,000 a year. Granted, it's a very high inflation rate, 5%, but it's all a matter of relative directions and the momentum of the portfolio. By the time they're 97, they're $100,000 short of their expenses. So that's how you now begin to know what to do. In this case, what I did is I'm doing this by memory. I removed a couple assets in order to fix this at 5%. So I'm going to remove a couple assets here that are just, I think we removed these two. Which, oh my God, I removed $500,000 assets. Now look at it, I took all the money out of it. But I replaced them with some projections on just income sources. I moved them from assets and I invested early on ahead of the ball with some income sources. These were the projections that the illustration showed for the income sources. They're going to come in as white, and the income sources actually fill the gap because they're increasing income sources. And now the savings, just at 5% inflation, went from being broke to actually having upward momentum. So that helps inform me what should be in the market. I've changed the relationship in this case from assets, just asset growing on capital asset growth, to income, forward investing on income sources that could not run out. Guaranteed lifetime income sources. And it changed the momentum of the portfolio and put a 5% broken portfolio back together again. So the name of this show was Why You Can't Decide. You can't decide if you haven't got the data to decide with, and you're just guessing what is best. Let me show you one last element, and then I'm going to wrap it up, about how to make these decisions. You can do this on a simple pie chart. Here's a demo client, actually the same client, right? Here's what they get in these different accounts. So here is the client's asset allocation put into a pie chart. Now this is a little different. This was sort of just a different approach, but again, we're breaking the inability to decide. Do you graphically ever do, I did this once for someone who had, I think, 7 million. So this person with $7 million was just, their whole investing methodology was just, they had enough money, they could just throw it up on the wall and see if it stuck. Buy something else, throw it up, see if it sticks. So I had the most combobulated, diffuse asset allocation. And I had to go, why do you have this? Seemed like a good deal. Why do you have this? Seemed like, what risk here is countered by some other risk? What in the portfolio is an opposite play of other things in the portfolio? It just all sounded good. I like these. I like that. I did good with them once, but one time I didn't do good with them. So this is a very simple portfolio. But what we looked at is this. When we broke it all down into asset classes, stock and mutual funds and ETFs, stock mutual funds, bond funds, stocks, cash, an annuity that they had. This was the look of the portfolio. So this is how much they had in stocks. Oh, this right here is stocks, 174. This is mutual funds, bond funds, cash, and they had a small annuity. So now this helps the client say, and by the way, we redefined it in this manner. If you take the bond funds, the stocks, and the stock mutual funds, and you put them together, basically this red is how much they have in equities. So what this did show, this pie chart demonstrated to the client, visually now, that of all your assets, you say, and this client said, I don't want to be at risk. I don't want to lose any money in the stock market. We go, you don't want to lose any money in the stock market, but this is how much you're in equities. 80% of your money is in equities. Well, I don't want to come out of the stock market. Good. I'm not telling you to. It's not an either or. What it is this the balance you like, or would you maybe like to put maybe 50% in equities, take this part of the pie, and move it into some of these safer preservation modes that I've been talking about? So this is why people can't decide. Everybody is so busy trying to find out what's best. They're not doing what any amateur investor, any amateur gambler would do, which is put some chips on different things, work it out. But if you've never worked out where your chips are, the types of places your chips are, you can't figure out where else they should be. It's just a jumble of trying to figure out what's going to work best, what's going to work best. So what I want to offer you is this. Go to our website again, straighttalkwealth.com, and you will find, first of all, we're still working on the triage here. It's not totally complete, but you get an idea where we're going. You can go here to get to the retirement roadmap. You can listen to our past episodes. This is our audio podcast. The video ones will be coming up shortly. You can see some testimonials from some of our clients, what they've had to say. Oh, there's a double row. Oh, I think we got some placeholders here because we have about 3 or 4 new ones we're trying to get in here. So we're still working on that. But what I want you to do is go to the retirement roadmap. You can find it here, and you can find it up top on the menus. Go to the retirement roadmap, fill it in. There's no cost, no obligation. Watch the video. The video will tell you a lot about how we do it. And then let us do an analysis for no charge and no obligation like you just saw. We'll figure out where you already are, what's working about it. Don't throw a baby out with the bathwater. But these are difficult times. As I said at the opening, why do we do Straight Talk Wealth Radio? Why do we do this show? We do it because things are going to change. And they're going to change in these markets. And you're not going to be prepared to flip the switch by the time they change. This is one other thing I want to talk about. This is how I've been through enough bubbles now in my career. I understand what happens. You have an environment, which is a risk environment. Whether it was tech stocks are overinflated in the late 90s to 2000. They're overinflated. Internet's gone nutty. It's an environment that doesn't seem right, but it still takes something to trigger it. Now, when the trigger happens, it's fast. At that time, there was a sell-off. It was actually a trigger within the market. I can't remember if there was another earlier one because I was new to the field. But then you have, for example, you have the real estate bubble. Clearly, the environment was telling everybody this is a risky time. But the good times just went. There didn't seem to be a trigger. Everybody got rich in real estate. We will do this game forever, and you're just a naysayer. An illogical environment is an illogical environment. That happens gradually. That's where the sensible look at it and say, it's time to be ready for what I can't see. And Lehman Brothers broke over collateralized mortgage debt and credit default swaps, the whole thing. And one thing broke. And it was the day that Lehman Brothers went belly up. The market panicked and people didn't get out in time. So when I say things are going to change, I want you to understand they've already changed. We're in an environment that has a large element of risk. We're in a deflationary environment. We're in a stagflationary environment. See the prior shows. You've got to stay invested, but the Fed is trying to crash the very thing you're invested in. And this will be a whipsaw. Stagflation will be a whipsaw between inflation and deflation. We just don't know what the trigger is yet. We've got them out there. We've got trouble in the Middle East. We're close to World War III. I didn't bring up an article in here which said the IMF says that we could lose 50% of the gains that the world economy's made. It's like a gouging gain if we go into a polarization on this planet of forces, good and bad, east, west, whatever. If that happens, the world economy is so tied in today that we will lose a major part of the economic gains that have been made for the last several decades. IMF is saying that, International Monetary Fund. So we don't know what the trigger, but there are plenty of triggers out there right now that can go. And all I'm saying is don't get stuck in the what's best indecision. Don't get stuck in the freeze of what's best. Get an analysis done of your own personal finances. Break down what assets you're in, what their exposure to risk is, what types of risks they're exposed to, and then just start to allocate that in a way that makes sense for your personal goals and makes sense for your risk. And you will sleep better at night, you'll be prepared, and you'll do as well as you can do without exposing yourself to getting knocked down. That's my advice. I hope that was helpful. I know we ran a little long today, but watch the video again at double speed and we'll get through it. But anyway, I'm not important. It's just the subject that's important. You're important, and how you do in life and your finances is important to us. So thanks for walking Straight Talk. Thanks for watching. Can you tell I'm not scripted and I'm not using a teleprompter? Thanks for watching Straight Talk Wealth Radio. I will see you next week.